Let's start this video with a quiz. Do you know what is common between Bharti Airtel, TVS Motor, Mahindra and Mahindra, Equitas Chemical, Apollo Hospital, BSC, MCX and Laurus Lab? Well, there are two things common. First, they are all massive wealth creator. And second, they have witnessed significant operating leverage. In fact, the reason why these companies have been massive wealth creator is because of operating leverage. That's where in this video we are going to discuss what exactly is operating leverage. Then what factors drive operating leverage? Now this is very important to understand because not every operating leverage is structural. Some operating leverage could be deeply cyclical, and it's very important to bifurcate structural versus cyclical operating leverage. So in this video, we'll look at multiple examples to understand how operating leverage create wealth for investors. Now I'm sure you would be more interested in knowing companies that are currently going through the operating leverage phase because that's where the wealth creation opportunity is. So what I have done is I have divided this video in two parts. This is the first part of the video where we will understand the concept of operating leverage with multiple examples. If you're really serious about wealth creation, this video could be extremely important. So watch it very carefully. Then in the second video, we'll look at companies that are currently going through the operating leverage phase. And more importantly, I'll show you how you can identify such companies yourself. Alright, let's get started with this video. So what is operating leverage? It is nothing but a situation where profit grows much faster than revenue. Simple. Let's say company revenue grows by 20%, but its operating profit jump by 50-60%. That is operating leverage in action. Now why does this happen? Because every business has two types of cost, fixed cost and variable cost. Fixed costs are expenses that largely remain stable irrespective of short-term revenue movement. For example, your factory setup cost, hospital setup cost, employee cost, technology infrastructure cost, R&D cost, network cost, exchange platform cost, and so on. Once these fixed costs are absorbed, every incremental revenue starts flowing disproportionately into profit. That is where margins expand sharply. Now let's understand the various drivers of operating leverage with examples. So first driver for operating leverage is scale. It is one of the most powerful financial engines for profitability. It happens when a company increases its revenue while its fixed costs remain relatively flat. So as the business grows, your incremental revenue directly flows into operating profit, resulting in margin expansion. And hence, profit growth becomes much higher than revenue growth. One of the great examples of the scale is platform companies. For instance, look at BSC or MCX. BSC operating margin has jumped from 21% in 2020 to now at 64%. What a crazy margin expansion. As a result, while its revenue has jumped around 8 times, its operating profit has jumped 25 times during the same period. In MCX, the growth is simply exponential. Operating margin has jumped from 9% in 24 to now at 71%. As a result, MCX revenue has jumped around 3 times, whereas its operating profit have jumped 25 times. As a result, both MCX and BSC have been a massive wealth creator for shareholders. Now in both BSC and MCX, what happened is they have built a high-tech trading platform, which is a relatively fixed cost. Now whether the market trade 1000 crore or 10,000 crore in a day, the exchange does not need to hire 10 times more people or buy 10 times more server. That means if trading volume rise by 30-40%, profit rise much faster because costs do not increase proportionately. And this is exactly why platform businesses are so powerful. Initially fixed costs are very high like technology, network, compliance, distribution, employee base, customer acquisition and so on. But after reaching a certain scale, the business becomes extremely scalable because every additional customer or transaction improves the profitability disproportionately. This is why market often give premium valuation to platform businesses. Because once operating leverage kicks in, earning growth can become explosive for many years. For instance, look at Ether Energy. Now in the quick look, you would find operating margin in negative and operating profit also in negative. Still, its stock price has jumped more than 3 times in last 1 year. The reason is because for an EV startup like Ether, there was a huge fixed cost like R&D, factory setup, charging networks that was spread over very few scooters. But as the scooter volume growth is growing with scale, those fixed costs are being absorbed. That's why in 2020, when its sales were 35 crore, operating losses were 185 crore and margin was minus 523%. And slowly when the sales picked up, operating margin improved and operating losses narrowed down significantly. And that's what market has rewarded. Likewise, there are many more platform companies. Look at Grow. In 2022, its OPM was negative. Today, it commands an OPM of 59%. As a result, while its revenue has jumped 10 times, its operating profits have zoomed significantly. Just look at Cartrade. Its margins have expanded from 9% in 2023 to now at 33%. So while its revenue has doubled, operating profit have jumped 7 times. As a result, its stock price jumped significantly, although it has corrected from the highs after AI-related uncertainty. Then second most powerful and sustainable driver of operating leverage is premiumization. This is where a company gradually shifts customer towards high-value products, premium offering, better variant or aspirational categories. The biggest advantage here is that company is not necessarily dependent on massive volume growth. Even if unit growth remain moderate, realization per product keeps increasing. For example, in auto sector, companies like TVS Motor and Mahindra are great example. In TVS Motor, earlier the business was more dependent on commuter bikes and scooters. But over time, the company successfully moved towards premium motorcycle like Apache series, premium scooters, export and even EV segment. Now premium bikes carry much better margin compared to entry-level bikes. So as the mix improved, EBITDA margin expanded sharply. As a result, in last 5 years, while its revenues are up 2.5 times, net profits have jumped around 4 times. And hence, it has created massive wealth for shareholders. Similarly, Mahindra transformation happened through SUVs. Earlier, Mahindra was seen as a cyclical tractor company. But today, its cars like XUV 700, Scorpio and Thar have completely changed the earning profile. Premium SUVs have significantly higher realization and margins. Plus, waiting period and strong demand improve the pricing power further. That is why Mahindra profit growth in recent years has been much stronger than revenue growth. Again, created massive wealth for shareholders. Even hospital can witness premiumization-led operating leverage. For instance, look at Apollo Hospital. As the business moved towards high-end procedures, specialty treatment, oncology, robotic surgery, and premium healthcare services, the average revenue per occupied bed has increased significantly. But the fixed infrastructure cost of hospital largely remain the same. So incremental revenue starts flowing disproportionately into profits. And that got reflected in share price growth. Another great example is Acutaas Chemical. Earlier it was more into basic chemicals, but it has slowly shifted towards high-performance intermediates. As a result, its margins have exploded from 18% to 36% within 2 years. So while its revenue jumped 2 times, operating profits have jumped 3.7 times. As a result, its stock price has jumped significantly. Likewise, look at Radico Khaitan. For many years, Radico was largely dependent on regular mass market liquor products where margins were relatively lower. But over time, the company has aggressively shifted focus towards premium and luxury brand like your Rampur, Jaisalmer, Royal Ranthambore and premium whiskey portfolio. At the same time, premium liquor brand also creates stronger brand loyalty and pricing power. Once a brand gets established in premium category, customers become less price sensitive compared to mass market segment. That is why in recent years, while its revenue growth is around 2 times, operating profit have jumped 3 times. No wonder Radico Khaitan has been a massive wealth creator for investors. Next, there is very interesting combination of premiumization and scale. It's Airtel. Airtel has spent heavily on spectrum, tower, fiber, network infra, but once this infrastructure is built, the incremental cost of serving more users or higher data consumption is relatively low. That has created strong operating leverage through scale. But Airtel's real transformation happened because of premiumization on top of scale. Over the last few years, Airtel has consciously focused on increasing ARPU, that is average revenue per user, through its premium plan, postpaid user, fiber broadband, Airtel Black Bundle and now 5G user. So even if subscriber growth was moderate, revenue per user kept on rising steadily. And since network costs do not rise proportionately every time your tariff hike or ARPU increase, a large part of incremental revenue directly flows into EBITDA and profit. That is why Airtel's profit growth in recent years has been much stronger than revenue growth. And that again got reflected in share price. Then third driver of operating leverage is operating cost normalization. This usually happens when a company goes through a heavy investment phase, where cost-wise upfront due to let's say R&D, employee addition, new plant or capacity expansion. But revenue and utilization comes later. A very good example here is Laurus Lab. Over the last few years, the company has invested aggressively in R&D, CDMO capabilities, and large-scale capacity building. During this phase, the profitability remained under pressure because fixed cost increased sharply while utilization was still low. But once this capacity started getting utilized and CDMO revenues improved, the same fixed cost base started getting absorbed better. As a result, its margin jumped from 15% to 26% in just 2 years. So while its revenue growth was around 36% in this period, its operating profit jumped significantly by 2.3 times. And that again got reflected in share price. Then fourth important driver of operating leverage is operational efficiency. This happens when a company improves business execution, productivity, asset quality or cost structure, leading to disproportionate profit growth even without extraordinary revenue growth. A very good example here is PSU Bank. For many years, PSU Bank struggled because of high NPA, weak underwriting and poor operational efficiency. But over the last few years, things have changed significantly. Their credit costs have fallen sharply, recoveries have improved, provisioning burdens has reduced, and balance sheet has become much cleaner. At the same time, digitization and better operating efficiency has helped reduce the cost pressure. So even though loan growth was not dramatically higher than private bank, profitability improved sharply because the leakage in the system reduced significantly. Just look at SBI. In last 6 years, while its revenue growth has only doubled, but its net profit has jumped 4 times. No wonder SBI has been a strong wealth creator. Then look at Bank of Baroda. In last 6 years, while its revenue has doubled, its net profit has jumped staggering 20 times. Now here please note that one very important aspect of operating leverage is valuation re-rating. When a company starts growing profit much faster than revenue due to operating leverage, the market usually starts assigning a higher valuation multiple as well. And this creates a very powerful combination for shareholder. First, profit themselves are growing rapidly, and second, their valuation multiple also expand. So the share price growth becomes even sharper. So if I quickly summarize, there are 4 key drivers of operating leverage: scale, premiumization, operating cost optimization, and operating efficiency. Now let us discuss the catch with operating leverage, because that's where majority of retail investors make the mistake. So after looking at all the examples, operating leverage may sound like a magical concept where profit keeps growing much faster than revenue. But this is exactly where investors make some of the biggest mistake in the market. Because there are 2 very different types of operating leverage. First is structural operating leverage, and second is cyclical operating leverage. And if you fail to differentiate between the two, you can end up buying businesses at worst possible time. The first type is structural operating leverage. This is what we discussed in companies like Airtel, BSC, Apollo Hospital, or premiumization driven businesses. Here margin expansion happens because of a stronger business model or scale or premiumization or platform economy or better utilization or operational efficiency. These are usually long duration compounding stories. But then comes the second type, that is your cyclical operating leverage. And this is where things become dangerous. In many commoditized businesses, operating profit can explode purely because of temporary supply-demand mismatch or sharp increase in product prices or sudden fall in raw material cost. In such phases, margins shoot up very sharply and earning growth looks extraordinary. For example, look at metal sector. It's a great example of cyclical operating leverage. Just look at Tata Steel. Currently, it is in operating leverage stage with margin growing from 10% to 14%, and hence, while its revenue growth is stagnant, operating profits have jumped by 50%. But the catch is volatility in operating margin. Just look at its historical margin profile. During 2020 to 22, margins expanded from 12 to 26% and hence operating profit simply exploded. However, it again fell down to 10%. That's called operating deleverage stage, and profit tanked. And this has been the case in the past as well, where operating margins have always been volatile. This is the same situation with all metal companies because metal is a commodity. So if you want to play the upcycle in commodity sector like metal, first you need to enter at right time when there is enough scope for margin expansion. And second, you need to have right knowledge of when the upcycle will peak out so that you can book profit on time before things go downhill. And trust me, it is not easy. A lot of people end up entering near the peak of operating leverage in commodity companies and end up losing money. There are many more examples like basic chemical companies during 2020 to 22 phase that jumped significantly and later tanked badly. Then another example is sugar commodity companies that witnessed crazy growth during ethanol blending boom and then margin tank. And today, companies like HFCL, Sterlite Tech are going through similar operating leverage phase due to high demand and lower supply of optical fiber cable. As a result, their stock prices are skyrocketing. We have recently discussed both the businesses in detail. Then another example, look at MCX. In last 2 years, while its operating margins have exploded, but just before that, its margin tanked from 47% to 9%. This has happened in the past as well, where margins fell down and operating profits fell significantly. This is the reason MCX has underperformed for a very long time before exploding. However, in last 2 years, we have seen a commodity super cycle with sharp increase in metal price including gold and silver along with crude prices. And hence, MCX has witnessed huge increase in trading volume and that scale resulted in operating leverage. Also, MCX has seen operational efficiency. Earlier, MCX used to pay very high fee for technology provider that would eat a lot of its profit. But now it has shifted to its own tech platform. So that fee has now gone, that has further boosted the margin. Likewise, look at capital companies margin like CDSL. So it's not a commoditized business, but its margins are a bit volatile, where it depends on trading volume. When equity markets outperform, trading volume increases, and so does margin. For example, during 2020 to 22 bull phase, its margins jumped from 40% to 66%, and hence operating profits jumped significantly. Also, the fact that its starting valuations were cheap in 2020 and then it witnessed valuation re-rating. As a result, CDSL stock jumped nearly 8 times during that 2 year of bull run. Currently, since the Indian market is not doing great, CDSL margins have been impacted and hence its share price has also seen a solid correction. Having said this, as more and more people invest in the Indian market, CDSL business would continue to grow structurally. But it will have its own short-term ups and downs. So whenever you analyze any business, make sure that you look at the operating profit. First of all, understand if it is a commodity business or a structural growth story. If the margins are extremely volatile, it's a commodity business. Try to avoid it unless you really understand the sector. Try to focus on structural growth stories where margins are less volatile. And within structural stories as well, you need to look at companies where there is further scope for margin expansion. This is again very important. When you invest in a company, past information is important, but what is more important is future growth expectation. And that is the catch. You need to deep dive into the business and understand what stage of margin expansion company is positioned and how much can it further expand its margin. Of course, nobody can know with perfection, but here you have to estimate based on your research. So if you can identify fundamentally strong companies that have good scope for margin expansion and valuations are still reasonable, you have hit a jackpot. Of course, it requires a lot of effort because you need to understand the business in detail, track quarter results, read the con call, identify the headwinds and tailwinds for the sector, and many people do not get enough time for that. That's where I try to add value with my join button, where I provide exclusive videos, and these are long and boring videos where I deep dive into the business along with sharing a detailed Excel sheet for every quarter results where I closely track nearly 200 companies. That is where you get the insight and investment opportunity. I also share my own investment strategies and investment thesis. Just to give you an idea, 75% of my community members are with me for more than 1 year now, and many people find this membership extremely useful. Okay, let me not stress this video further. In the next part, we'll go one level deeper and look at how you can actually identify companies before operating leverage fully shows up in number, because that's where real alpha is created. So that's it from my side. Now you tell me in the comment which companies have further scope for margin expansion. And if you find this video useful, do share within your circle. I'll see you next video. Till then, take care.